Okay, Chapter 7, Fraud and Internal Control, particularly of cash. Okay, next slide. All right. The study objectives for this chapter then. We're only going to do the first through 4 here. Define fraud and internal control. Identify the principles of internal control activities. Explain the applications of these principles to cash receipts. And do the same again, explain the applications to cash disbursements. Now, to begin with, fraud is a dishonest act by an employee that results in personal benefit to them, the employee, at the cost of the employer. Now, there are 3 factors that contribute. First of all, opportunity. Somebody is going to commit fraud if they have the opportunity and they're under some kind of financial pressure. And both those then, when they commit the fraud, they begin to justify it, rationalize it, or justify it, that the company deserved it. So, I mean, these are the 3 factors. So we set up ways in order to reduce the opportunity. Internal control, what we're talking about here are methods that help us to protect the assets of a company, safeguard them against theft, and enhance the reliability of accounting records. And all of this then leads to more increased efficient operations. There are 5 primary components to internal control. There's the environment, risk assessment, control activities, information and communication, and monitoring. Now, this we just cover very briefly. Okay, principles of internal control. What you have to do, have effective control, is to have one person responsible for a given task, not 2 people, because if something is missing, one will blame the other. So you give the responsibility to one person for one task, but you segregate the duties. You take the duties and give some duties to one individual and some duties to the other individual. And in that way, you set up a way that if there's going to be fraud, 2 people have to be involved. One has to convince the other to commit the theft. Another way of controlling it is to have pre-numbered documents. And therefore, if the documents are out of numerical order or don't have a number on it, then you know it's a phony document. All right? So here are some of the principles of internal control. First of all, physical controls. There are safes and vaults and safety deposit box. And you can lock up a lot of things. You have computer facilities with passkey or fingerprint or eyeball scans. You have television monitors. You have time clocks. You have alarm clocks to prevent break-in. These are all physical controls that a business puts in place to safeguard their assets from theft. Now, you also have other types of control activities. You have independent internal verification. That is, periodically, you have to go over and check on what the other employee has been doing. Okay, and if there's anything that you're discrepant, anything that you suspect, you have to report that to management. There are other methods too. First of all, the way you assign duties. You can rotate employees and make them take vacations. So that you have somebody in one job for a while, then you make them move to another job and have somebody else in that job, so that if they were doing anything, then it would be difficult because you're rotating them. When you bond employees, that's like having an insurance policy. Many companies in Canada and States, if an employee deals with a lot of assets, a lot of cash, we can have an insurance policy on that person that's called a bond. That means if they do steal, then that insurance company has to pay up the money. So the bond company then really looks into the background of employees in doing that. Now, the one asset that is easy to steal is flus, cash. You know, computers have serial numbers, and you can easily identify if this desk belongs to you. If somebody stole a desk, well, you know the desk could have come from the business, or anything else, the inventory an employee could steal. But they would be able to trace that. But you see, cash you can't trace. So again, it's very important now that you establish responsibility for cash. One person handles the cash, but that one person who handles the cash tells the other person records the cash. So you have segregation of duties. If the same person handled the cash and recorded how much cash was taken in, well, you see, that sets up an opportunity to steal cash. But if the person who receives the cash from the customer gives that to another person to record, now you see, neither one of them by themselves can steal. They would have to get together to steal. So that is a major cash control, cash receipts control. Also, you can do independent verifications again, just like we talked about before. Also, you require employees to take vacations, and you change jobs often, and you have physical control. So these are the ways we can control for cash. Cash receipts control, the clerk who rings up the sale counts the cash, but the cash then goes to the cashier. The cashier then puts deposits and sends one deposit slip to the accounting department and puts the money in the bank. Now the accounting department records the cash register, and the only person who has access to the cash register tape is the supervisor. The person who is the cashier does not have access to that tape. Okay, so cash receipts control, if we're getting cash coming in the mail, well, the mail should be opened by two people, a list prepared and checked, and each one signs off that that was the exact amount of cash that was received. Other cash controls for disbursement. This is when we pay out cash. Again, the same thing. We establish responsibility for one person, we segregate the duties, and we document the procedures. And again, we have an independent verification. We require employees, whoever is responsible for paying bills, we require them to take vacations and rotate jobs. Okay, so that's it for that chapter.